In this video, we're going to be talking all about the S&P 500, which is one of the most popular index funds out there. We'll talk about what it is, its pros and cons, and how you can start investing in it today if you are a beginner investor. Let's get into it. Hey guys, what's up? It's me from the channel where we learn to grow our wealth slow and steady. In this video, we're going to be talking all about the S&P 500, which is probably one of the most famous index funds out there. And because of that fame, it also has a lot of misconceptions surrounding it. So I'm going to clear some of those up in this video so that you can decide whether or not it's right for you. First, let's start with what the S&P 500 actually is. The S&P 500 is an index fund that tracks the 500 largest companies in the United States based on market capitalization. Market cap is just a fancy way of saying that it ranks them by the total value of their outstanding shares. For example, as of recording this video, the company Apple has the highest market cap at over $2 trillion. And this ranking is updated every few months. To stay in the index, companies must be headquartered in the US, have a minimum market cap of $8 billion, and meet certain liquidity requirements. If they no longer meet these criteria, they are removed from the index and replaced with another company that does. The S&P 500 represents around 75% of the total U.S. stock market capitalization and includes companies across various sectors such as technology, healthcare, financials, consumer staples, and more. Some of the biggest names in the world are part of the S&P 500, including Apple, Microsoft, Google, Amazon, and Johnson & Johnson, just to name a few. And since it covers a wide range of companies and sectors, it's considered a great way to diversify your portfolio without investing in individual stocks. Now that we know what it is, let us go over some of its pros and cons so you can decide if it's right for you. The first pro is that it has a very low fee. The expense ratio for an S&P 500 index fund is generally very low, typically ranging between 0.04 and 0.7%. That means that for every $10,000 invested, you pay between $4 and $70 in fees annually. This is much lower than actively managed funds, which typically charge 1% or more. Lower fees mean more of your investment goes towards actually buying the stocks within the index fund, which can lead to higher returns over time. Another pro is its long-term performance. The S&P 500 has a long history of generating positive returns over the long term. Since its inception in 1926, it has seen many ups and downs but has consistently trended upwards. On average, the S&P 500 has returned around 10.5% annually. Keep in mind that past performance is not indicative of future results and that returns may vary depending on when you invest. But this historical data does suggest that it could be a solid long-term investment. A third pro is its diversification benefits. As I mentioned earlier, the S&P 500 includes 500 of the largest companies in the US and covers a wide range of sectors, which means that it's already diversified. By investing in the S&P 500, you're essentially investing in all of these companies and sectors at once. This can help reduce your overall portfolio risk without having to do much work. Just by holding an S&P 500 index fund, you're getting instant diversification, which is especially beneficial for beginner investors who might not have the knowledge or experience to build a diversified portfolio on their own. Okay, now let's talk about some of the cons of investing in the S&P 500. The first con is that it doesn't include small cap companies. The S&P 500 only includes companies with a large market cap, which means that it doesn't include smaller companies that might have higher growth potential. These small cap companies are considered to be more risky, but they also have the potential to generate higher returns. By not including them, the S&P 500 may be missing out on some potentially lucrative opportunities. Another con is that it's US-centric. As the name suggests, the S&P 500 only includes companies based in the United States. This means that it's not diversified outside of the U.S. economy, which could be a problem if the U.S. economy underperforms other economies in the world. If you want to invest in the global economy, You may want to consider a fund that includes international companies as well. Finally, the S&P 500 may not be suitable for short-term goals. As we discussed earlier, the S&P 500 has generated positive returns over the long term. However, in the short term, it could go either way. There have been times in history where the market has crashed, and it could happen again. If you have a short-term goal that requires the money in less than 5 years, it may be best to avoid the S&P 500 and invest in something more stable like a savings account or ACD. Now that we know the pros and cons, let's talk about how you can start investing in the S&P 500. There are two main ways to invest in the S&P 500, through an index fund or through an ETF. Index funds and ETFs are both types of investment funds that allow you to buy shares of the fund, which in turn buys a small piece of all the stocks within the fund. They both offer the same benefits of diversification and low fees. However, there are some differences to consider. Index funds are typically only available through brokerage accounts and often have minimum investment requirements, meaning that you need a certain amount of money to invest in the fund. ETFs, on the other hand, are traded on the stock market like individual stocks and don't have minimum investment requirements. This makes them a good option for beginner investors who may not have a lot of money to start with. ETFs also tend to have more flexibility in terms of when you can buy or sell them. Index funds usually have set periods during the day when you can buy or sell them, but ETFs can be bought or sold at any time during trading hours. Some popular index funds that track the S&P 500 include the Vanguard S&P 500 Index Fund, the Fidelity Zero Large Cap Index Fund, and the Schwab Total Stock Market Index Fund. Some popular ETFs that track the S&P 500 include the SPD RS&P 500 ETF, the iShares Core S&P 500 ETF, and the Vanguard S&P 500 ETF. No matter which fund or ETF you choose, it's important to do your research and make sure that it aligns with your investment goals and risk tolerance. As we talked about in this video, the S&P 500 is a great option for beginner investors looking to build a diversified portfolio without investing in individual stocks. It has a low-cost, long-term performance and diversification benefits, making it a solid choice for long-term growth. However, it doesn't include small-cap companies. It's US-centric and may not be suitable for short-term goals. By understanding the pros and cons of the S&P 500 and doing your research, you can decide if it's right for you. And if it is, you can start investing in the S&P 500 through an index fund or an ETF. Remember to do your research and choose a fund or ETF that aligns with your goals and risk tolerance. And always remember to keep learning and growing as an investor. Thank you guys so much for watching this video. If you enjoyed it, please hit the like button and subscribe to the channel where we learn to grow our wealth slow and steady. And if you want to continue learning about investing, check out this video on the 3 best low-cost index funds for your portfolio. Until next time, take care.